professional. How about now? Still nothing? You hear me? Can you see the screen, Tim? Oh, all right, good. Wonder if there's like a little delay. I'm used to them. Yeah, you don't hear snoring. Stop it. She's not snoring. Trust me, you would hear snoring if she starts snoring. She will be in about 5 minutes hearing my voice. No sound, screen is good. That might be on your end, Lucas. You can't hear me, so I can't help you. Everybody else seems to be okay. I'll give you guys a second here. I got to, let me post one more thing here. Oh, I posted it? I'm good here. All right. All right, good. All right, a couple things I wanted to talk about today, and I try to take it slow and not lose anybody who may not be too familiar with some of the stuff we're going to talk about today. But I think it's important to keep an eye on. And, again, today's a good example, right? You have earnings season. Yeah, we're going to play through this environment no matter what, because we're degenerates. But, if there's some more important things to pay attention to, you're better off probably keeping an eye on the more important things than, spinning your wheels, because that's what we're doing in this environment. Listen, and not to take away from anybody out there who can make money trading in a mess of a market like we're in right now. There's some volatility intraday, but for a lot of us who try to utilize sweeper activity, for stock picking purposes and an edge, this is tough. Today was really tough. Again, for the reasons we talked about, okay? This week in particular, right, earnings season as a whole is always messy. So that's no surprise. But you have earnings season and you have a monthly OPEX. It's nearly impossible to trust anything outside of weekly speculative activity. I mean, that's the truth of the matter. Okay? No matter what. I'll give you a perfect example. And then we'll go on to the more important things. But just so I get my point across, especially for those of you who are Steamroom members, and it goes in one ear and out the other. Today, okay, there was some late action lows. There was put action in lows, okay? And for those of you who think that, Jesus talks about earnings, it's tough to trust this week, even though it's earnings season. But maybe if I look into it a little deeper, I can figure out what may be clean, what may be not. Lowe's caught some decent May put action towards the end of the day, okay? And at first glance, you look immediately at earnings, right? You want to know if it's earnings protection or not. That's kind of what's sapping a lot of the edge from the signal from sweeper activity. This in particular, right, May 23rd, they report May monthlies. Again, I don't even know if they catch, but pretend it doesn't catch earnings, because you guys know me with the dates, right? Maybe it doesn't catch Lowe's earnings. Now, this is easy to think of, because there's one main competitor in that group. It's Home Depot, okay? And a lot more now than ever, if these funds, hedge funds, or even players in general, when they want to make a play or want to hedge against the play in a group, a lot of times they don't focus on the name that's reporting, okay? Because IV could be jumped up a little bit more in that particular name, right? They'll look to one of the main peers in the group, right? That's highly correlated. So in other words, if Home Depot reports numbers and they knock the ball out of the park, right? Stock goes higher, it'll likely drag Lowe's higher with it, right? I mean, there's a very strong possibility of that. And on the flip side, same thing to the downside, Okay? So what I'm getting at here is you had some, a little aggressive put action late in lows. At first glance, you may think it's not earnings related because it doesn't catch Lowe's, their particular earnings date, but you go and look and Home Depot reports, I think, on the 15th, and it's likely protection against Home Depot's quarter, okay? So that right there is just an example of the problems in trusting any of the sweeper activity flow in general through at least the first few weeks of earnings, okay? You throw in a monthly OPEX where you have both calls and puts, a ton of positions that go poof and expire Friday that need to be replaced, right? If you have protection on, you need to replace that if you want to remain protected. If you have some exposure in whatever name, you want to keep some of that on. You have to replace some of those call positions in OI sitting there in April. Okay, so that's not aggressive buying. Replacement is not aggressive buying. Hedging is for earnings, right? Or stock replacement for earnings is not aggressive buying. So that's not what we want to focus on, and it's just not a strong signal. All right, but again, we're probably, especially on an intraday basis, doesn't mean you can't try to play if you think it can create some momentum intraday. But that right there, in a nutshell, that's the problem, and why a lot of us you hear moan earnings season, and you throw OPEX into the mix. It's not a good backdrop. All right. So that being said, we probably have next week and into the week after, we don't have to deal with OPEX anymore, luckily, but we still have earnings to deal with. Once we get through some of the mega cap NASDAQ names, the Apples, the Amazons, all those, that's when things start to clear up, And what I mean by clear up, you still have names reporting, but right now you have every high beta, every big influencer of a name that still hasn't reported yet. So right now, everything is earnings flow. Everything should be considered earnings flow. So as we get through the next couple of weeks, not only will we have names that are already reported, we'll see post-earnings action, but we'll see some cleaner activity overall, okay? So let's talk backdrop in the meantime, because I think it's a good time to focus on that while we try to sit patiently and again, our goal is to spin our wheels the next week or two. We spoke about, again, the last 2 weeks, but going back to last week in particular, I'll leave this stuff for now. We spoke about how we continue to see a setup for where dips should find buyers, right? We've been talking about that since a little after the SIVB went poof, okay? You had a bump up in liquidity, you had the Treasury step in, bail out the banks, you had a lot of bearish positioning and sentiment off that banking event, a rush to cash, right? So what we discussed over the last few weeks, little by little, as the banking crisis subsides, each and every day that goes by and you get less and less noise from the banking sector, right? No new news. That pile of cash, right, that's been raised from fear and de-risking off that crisis will start to unwind. And the speed of it, again, there's no way to forecast how long it may take to unwind. But what we were talking about is at the least, you will probably see that a strong buy the dip mechanism in the market, okay, until we see cash being withdrawn, right? So some of those safe haven assets start to see outflows, and that money being deployed to risk, okay? So that was kind of what we've been focused on for the last, several weeks now. Now, last week in particular, what we wanted to touch on, which was important, okay, was even though we were seeing that buy the dip, a still strong, high possibility of that buy the dip sentiment out there that should linger, further upside, right? So continued momentum to the upside, meaning or short covering or repositioning or whatever it was that was a catalyst for a lot of this move, we already saw that play out. Okay, that egg has already hatched. Okay, and I'm going to go one by one here so everybody can follow along. What I'm about to show you now. Okay, two things here. One is this. This chart will tell you everything you could possibly want to see. Oh, here it is. Okay. CTAs, right? We spoke about CTAs, how they were one of the major pillars within this rally. Okay, they were short. They got short pretty aggressively, and they were going to be buyers in up, down, sideways, crooked tape, right? All the way up until last week, where coming into this week, it was going to die down. And I think this is all you need to know on that front, okay? And we spoke about this last week, but even now it's obvious, okay? And this is from Goldman. CTA positioning has slipped from notably short to near 25 billion long at this point, okay? So now their model has, in a flat tape, CTAs are now sellers. Okay? So in a flat tape, a tape that does nothing, right? Kind of the type of tape we've been seeing, it feels like, for months, but it's only been a week or two. Okay? They are now net sellers. They are not buying on every little dip. Right? And look at this chart. I mean, does this not say everything? Look at this. Okay? This is how aggressive that CTA bid has been in the market, right? And it's obvious, right? You see it in the price action on a day-to-day basis. Any little weakness, right? Any little weakness that you're like, oh, maybe here we go. We get a little pullback, gets inhaled, right? It got inhaled. And okay, this is what it looks like on their model. From short to now, basically, they're done buying. The tank is full. Okay, in a short period of time here. All right. And again, this is something we discussed last week, kind of in anticipation of coming into this week. We kind of we're getting a heads up from Goldman that the buying was going to dry up in pretty meaningful way as the days and weeks move on here. Okay. So I think that's kind of one of the more important things to acknowledge here. Okay. We spoke about last week how the upside wasn't there, right? We still had the high probability of buy the dip, but to see a continuation in the rally wasn't there from what we were seeing early on in this move, okay? Now, I think we're at the point where we're missing that buy the dip as well now from this crowd, okay? And where they're net sellers completely on the other side than buyers. Okay, so we might see, or we're likely to see, that buy the dip into any little weakness disappear. Okay, doesn't mean the market's going to new lows. Doesn't mean the market can't grind higher if Apple knocks the ball out of the park or whatever other name reports. Okay, it just means for no apparent reason whatsoever, like we've been seeing throughout this little consolidation here, where every little dip was bought. We're likely not going to see that anymore. Okay? On the cash front, right? And this was more towards the money market funds, right? This was more towards that buy the dip mentality, right? Because again, if you're in cash, any little weakness, you want to put some of that risk back on that you took off into the fear, you're going to likely, any little weakness, you're going to likely deploy some of that capital, okay? Now, there's something interesting here. We spoke about this, okay? This is the money market, one of the charts we were looking at, the money market inflows, outflows, okay? And what we were talking about last week is that here's the rush into money markets, okay? Into the heat of that banking issue, okay? And you could see the unwind over the last few weeks. Now, what was interesting about the unwind is even though the inflows weren't as, or to the magnitude that we were seeing into the fear, there were still weekly inflows into money markets the last couple of weeks. Meaning net for the week, money was still going into money market funds. Okay, not coming out. It's the process was just slowing down. Less money going into money markets. This was the first week. Okay, and again, this is what we kind of honed in on. We would at least see at least the start of outflows from those money market funds. Okay, and this is the first week now. We got the data late today. Here's what it looks like there. I'm hopping around. This is dangerous. Hold on. I made sure. Okay. Here's the data from today. Money market funds have the biggest weekly outflow since 2020. If you remember, they had the biggest weekly inflow the last few weeks since 2020. Okay? Same exact situation. Fear, there's a rush to cash. Who the hell's calling me here? Fear, there's a rush to cash, and then you see the unwind, right? Now, what's interesting here in particular is that you had taxes as well. So a lot of people are making the argument that, people have to pay taxes, and that could have played a part into money being withdrawn from money markets. What I will say to that is tomorrow we'll get a pretty good idea, or actually later tonight, we'll get a pretty good idea of how much of that money being withdrawn from money markets went into equities, and in which equities, what sectors, and what type of equities they went into. Okay. What I did see today, high yield funds, which are considered more risk on at times, they saw inflows. Okay. So there was that sentiment behind some of this transaction where they were putting on more risk. But let's see what it looks like tonight. Later this evening when Bova comes out with the numbers, we'll see, how much of this withdrawing of money markets went into what sectors and what type of equities. Okay. So the point here is, on this in particular with the money markets, at the least we would see outflows from money markets before this buy the dip play came to an end, and we saw it this week. Okay. So you could put a check next to that box. All right. So again, just based off CTAs and now outflows from money markets, it kind of, we were talking about how the probability for that buy the dip was still strong. Okay. You have to take that probability down now. Okay. Based off what we just looked at, CTAs and money markets. Okay. That has to come down now. So it's not as strong. Okay, of strong odds of us seeing the aggressive buy the dip as we've been seeing. Okay, another major factor to why these markets have held up in the face of a lot of negativity and fear and banking issues were, some of the other things we look at. And positioning is one thing, especially since the banking crisis. We talk about sharp hedgers and riff-raff specs, right? We talk about that every week. And again, this is going to be interesting to see tomorrow how they shake out. But this is last week, right? So through the process of this rally, since that SIVB issue, okay, the more conservative money, the smart hedging money out there has actually been adding long exposure, okay? While the more aggressive speculative money via hedge funds and riff-raff specs, right? The more speculative, smaller money out there, they have been short, okay? So what was interesting is last week, I got the chart here, I think. Yep, look how prepared I am. This is the most speculative type of money in futures, okay? In the contracts there. And you can see here, they were aggressively short into the banking crisis and aggressively covered that short, right? Getting slightly long. Last week, last week, they dipped back into net short again. Okay? So it's not like they're getting all bulled up here. There's still some fear lingering in this money here. And I think where this stands for us now, okay, with everything else we're seeing, this still tells us that the odds that we're going to see something climactic and this market rollover in the face of this type of positioning is extremely slim. Okay? Extremely slim. Right? So, again, in English, simple English, we look for opportunities off the normal pullbacks out there. Okay? Not the intraday down 0.3% that we've been seeing, but when we get a multiple day sell-off, right, off some negative news, and you hear all the bears start talking about crash and new lows and everything else, the likelihood is, based off what we're seeing on this front here, that there is nothing climactic that's going to resolve from there. Okay? So that would, again, that's been my takeaway since they aggressively covered that short position and got long. And that's still my takeaway to this day. Okay? I think, even more so that there was a banking issue and they not only remained long, but added to longs. I think just, reaffirmed everything we've been discussing on this front. Okay? For those of you who, not yet, I was going to get it. I got one thing for you bears out there that might be interesting to keep an eye on. And again, I think it needs to materialize and you need to keep an eye on it. But something that I'm looking to throw you guys a bone, okay? This is back in the bullish column again before I get to bears. This was the Bank of America Global Fund Manager Survey, right? Comes out every month. And it's been the same story for, I think, since last summer, to be quite honest. Fund managers are positioned like it's 2008, okay? What's been incredible is we've seen fund managers they've been extremely bearish for such a long, the professionals out there, right? They literally have hardly any exposure to equities, okay? What's been missing from that throw in the towel moment that a lot of us have been waiting on is the passive investing crowd, right? The equity fund flows. They haven't capitulated yet. But it's rare. What's rare is you see the professional community so bearish and so fearful, and we haven't really seen that. Again, we're starting to see the early signs of it, right? It's in motion, but we haven't really seen that yet from that passive investor crowd, okay? But going back to the pros here, it's insane, okay? This is the April Fund Manager Survey, and you could see Hartnett, who writes this up, is as bearish as anybody out there, right? And he's got to acknowledge that it's really difficult to see any type of bear move with this type of sentiment and positioning on the professional side, right? Here, I think this chart really tells it all here, right? So this was into the October lows. And if I remember the title, it was So Bearish, It's Bullish from Hartnett, right? You had a tiny little bump up since then. And then, the last month or two back almost down to the lows of October again, right? Like, look at October 08 back here. Like, that's 08. The world was coming to an end, So, and again, Hartnett, and this is why a lot of us respect him, he's bearish, he remains bearish, but he makes the argument, right? He doesn't think this is a new bull market. He doesn't think this is real risk on the start of a new bull market that you want to see to get aggressive on the long side, right? But point being, you really can't get bared up, and you got to look for opportunities from time to time on the long side into pullbacks when you see this type of shit. Okay? So I think this lines up with what we're seeing from the Sharpie positioning, what we're seeing out of the credit markets with swaps and spreads, right? Showing no concern whatsoever. This continues to tell us that we're likely going to remain in this range for quite a bit. Okay? Does it need to unwind maybe not completely. You don't need to see a complete unwind before you can potentially see new lows in the market, right? But again, to make the argument that you're going to see new lows, right? You really need a credit event, right? You need something major for the market to pay bears, right? When positioning looks like this, it's just so rare, right? There was a period in '08 where bears got paid, but bears got paid. I mean, everybody was losing money in every facet of the world, of the global economy, right? You were making, if you were short equities, you were making money. You were getting destroyed everywhere else, if not worrying about your money being even around the next morning. So it was just a rare event in '08. So is it possible? Anything is possible, but it's just the odds of it are extremely, extremely low. Okay, and just of course, here's cash amongst fund managers, right? So off the highest level, off in the October lows there, but not much difference. Look at this, most overweight bonds since '08. Okay, look at that. Look how rare that is. What else was interesting here? Here, bonds. This is positioning. Investors are overweight bonds under, look, complete different sides of the spectrum here. Bonds, all in. Equities, nothing to do with. Same here. Cash, everyone in cash. Equities, everybody out. Right? So again, I think this all just confirms that exactly what we've been talking, like a broken record. Range bound market, look for those sell-offs that we do see within the range. That's where you want to look for opportunities, right? On the long side, looking for that squeeze, looking for that rally. We've just been recently here, we've been in a rare setup where every little dip was going to find some sort of buying. You know what I mean? Every little dip. I think that now has started to unwind here, right? We're seeing that officially being unwound, okay? And potentially now, and this is what I'm hoping for anyway, as a bull, that we see some normal selling, right? You get a little bit of a couple days of weakness where you get some of the sentiment stuff to line up in your favor again on a short-term basis. And then, you look to see what names are catching flow coming out of that pullback, right? We haven't seen it since the banking issues here. And now, we're in earnings season, so we're not going to see shit. All right? Before I forget you bears, I think this was really, really interesting, okay? This, on the street, Matt King from Citi is liquidity Jesus, right? When it comes to liquidity, anytime he opens his mouth or writes anything, everybody who pays attention to anything related to liquidity is going to pay attention when Matt King brings up something. And he's kind of been bringing this point up regularly for, I would say, since the February high, February where we topped out in the market, okay? And liquidity topped out. But he's kind of reiterating it now because he thinks we're closer to that point. What he's looking for, he thinks we're past peak liquidity, right? He thinks what happened was, while everybody thinks that it's a new bull market or for whatever reason we've rallied off the October lows, the only reason we've rallied, the only reason the market looks like the way it does is because liquidity stopped tightening exactly at the October lows, and we sort of bump up in liquidity since, right? For those of you who don't have access to anything, any fancy-pantsy indicator or anything of this Wall Street research, I have it on here, don't I? Yep, this is it. Hold on, I'll move it down here. You can search on TradingView. There's some liquidity. Let me move to, yeah. Okay, so this is kind of a global liquidity proxy, not the Fed. This is the whole enchilada. ECB, Fed, Bank of Japan, everybody, okay? And this is what Matt King's referring to here. Wait, there we go. Here, right? Here, that yellow line we're paying attention to, okay? This is liquidity being drained from the system, right? This is what all central banks were looking to do, to tame inflation, okay? They looked the devil in the eyes, right? For whatever reason, the gilt market in UK, the bond market had trouble, whatever it was. It stopped on a dime right here, okay? Again, coincidence? Maybe. A lot of people think not. That right there was the end of liquidity being drained from the system, and you see the increase in liquidity here, right? Which has benefited a lot of risk assets, okay? Now, what's interesting here, according to Matt King, and again, I'm trying to dumb it down so even I can understand it again, but he was talking about that's it, okay? This bump up in liquidity that we've seen, okay? There are reasons for it. There are legitimate reasons for why that happened, okay? It's done, okay? That's what he's talking about, past peak liquidity, okay? He thinks now liquidity has officially topped out and you're going to start to see it drain again, okay? He feels that we were seeing the process already start here, but SIVB went under, right? And what happened was they needed to act, and then you get the bump up because of the banking issue. But now, with the banking issue having resolved, right, being resolved, no other headaches, okay, he's making the point that now you're going to start to see this liquidity start to tighten again. And he feels like it's a risk, especially to the stuff out there that's acted and looked like QE has been in motion again, right? I mean, you look at some stuff out there, it's looked like QE has been back in play, all right? And Matt King's point is it may have looked like that for a period of time. It's over, right? Bitcoin, a lot of spec names, a lot of names that should be bankrupt by now. We're seeing short squeezes. AI, everybody finding the new 2000 internet stock, it felt like, okay? So he's making the point you're going to start to see cracks there. You're going to see that go first. And then he thinks there's a risk that it weighs on equities. And again, let me use his language so I don't ruin it, okay? And here's a chart right here. Focus on this one here, okay? This is basically global liquidity, right? And you see here, this is into 2022, the October lows, right? The aggressive tightening. And then look at this slingshot back into positive territory. Here's what he's forecasting for the remainder of 2023. You see it? Okay, so he's forecasting, obviously, liquidity being drained. And again, I don't want to go over the reasons why this happened because I can confuse myself even as I explain it, right? We'll save that for another webinar. But again, it's the net takeaway that matters a lot of times, right? So this is the last comments of Matt King's post, and I think it does a good job of telling everything you need to know. So he would not be at all surprised for it to be replaced by $600 billion headwind. That's what he's expecting. He thinks may happen, right? So 600 billion being withdrawn from liquidity, right? And he even makes the point that the hedge funds getting short in the futures market, right? A lot of people talking about that. You can see it in the COT data, right? I'll look at it. I'll show you guys after this. He thinks that's a lot of the hedge funds that swear off of liquidity front running the potential draining, right? So he makes the point, elevated speculative shorts in the CFTC data and defensive survey positioning suggest some investors are wearing seatbelts already. Okay, in other words, getting prepared for it. Equities, what people who pay attention to liquidity are already hedging. Equities at year-to-date highs and central banks' general reluctance to consider these effects suggests many are staring out the windows. Keep watching the liquidity data and buckle up. All right? So, again, this is not some schmuck on Twitter. This is the guy when it comes to liquidity, and it's at the least worth paying attention to and watching, right? And these days, again, I go back into my rocking chair. Back in the heyday, in my prime, you never had access to, I think you almost have too much access to this information now, right? People overdo it, right? They want a signal every day from it. But I think this is something really important. Again, maybe it doesn't play out, right? Maybe it doesn't work that way. Maybe something else breaks and the Fed and the Treasury have to cough up again. That's definitely possible, okay? But if that doesn't happen, it's worth paying attention to, right? And in simple English, so you get an idea, what you're likely to see is this yellow line move south, and you see how highly correlated a lot of these more risky, more speculative assets can be when liquidity starts to go the other way. Treasury General Account, $300 billion liquidity used to prop markets back in 2021, now a drain. Yeah. And again, that's why I'm being honest with you guys. I'm not educated. Who's this? Oh, I'm not educated on this matter. This is not my cup of tea. This is not my niche, right? I look at it when I'm told to pay attention to it, and that's the extent of it. But there are legitimate reasons for why there's been a bump up in liquidity. Obviously, the banking issue was the most recent one, but even prior to that, with what some of you are talking about in regards to Yellen and the Treasury, right? If you read the whole Matt King note, he'll break down every detail you want, right? If you're interested in it. But I just wanted you to bring it to your attention, the most important point, because here's the thing, right? It's been a strange market to begin with, right? And that's what a lot of us, who really are not convinced that this is the start of a new bull market. It doesn't have new bull market characteristics, right? A lot of the stuff that shouldn't be leading has led at times, and then at other times it hasn't. It's just been extremely random. But there are reasons for why the more speculative stuff has been acting in such a positive manner more recent. Okay? And we'll see, right? Maybe this is the start. Bitcoin likes to lead, right? Likes to front run this shit a lot of times. If I remember correctly, it doesn't look like on this chart, but Bitcoin was the first to go off the recent liquidity bump to the upside. But I could be wrong there. All right, but maybe the weakness we're starting to see in Bitcoin is a foretell on what may happen to liquidity. Okay, doesn't mean markets crash new lows, right? What it may mean is that a lot of the more speculative action that we've been seeing out there and at times enjoying is not going to be around anymore. Right? You hear all these things about the Fed is draining liquidity, tightening things up, and then we saw a period in AI stocks that look like Bitcoin mania and Cathy boom. You know what I mean? Again, you can call it all coincidence, but a lot of us think not. All right, so it's something to keep an eye on, at least these over the next few weeks here as we get through earnings season. And again, it's going to be easy. It's going to be easy to notice. It's going to be easy to notice because you're going to see a lot of the more speculative stuff start to really crack. And you're going to see a lot of these liquidity proxies start to roll over. Okay, but net, from what we're seeing, what I think we want to see, right? And what I mean by we who follow the stuff we're looking at here, everything is still signaling to us that we are in the same exact type of market that we've been in since last summer. Okay, same thing. There hasn't been, look, right? This, right? We look at it all the time, and there's nothing to look at. There's nothing to look at, but it's worth paying attention to because this is where you're going to see some of the cracks when they start to show up. All right, so this is credit default swaps and equity volatility, right? Heading south. All right. Again, banks are tightening lending, all the things that you usually hear when recession is coming to a theater near you, okay? But the signals are not reacting yet. They're not concerned yet. For whatever that may mean, right? Maybe it's not as close. Well, that's been the case, right? It's just not here yet. It's just not here yet. But until we see this stuff start to signal that this climate is changing, there's no reason to try to get cute and outsmart what we've been seeing since the last summer. Right? Now, that being said, doesn't make the market any easier. I don't know about you guys, but for me, it's not like I'm trading. I don't feel like I'm trading in a bull market. Most of the days I'm pulling my hair out of my head, wondering how these stocks look like this, and all of these stocks can't get out of their own way. It's been really, really a really frustrating market, I think, for both sides, for everybody. But that's what these, people think bear markets just ruin bulls. They ruin everybody. They ruin everybody. They wear out. And if you remember, again, I'm not an I told you so type of guy. You guys know that. But I remember us having the conversation. A bear market can spend a lot of time wearing you out by just doing not much, right? It ends up frustrating and boring people to death, right? The bears want to crash, the bulls want the bottom and the new bull market to start, and what do you get? Mishmash, and neither of the two, right? And again, for us bulls, I know, like for me, look at this, right? You look at home builders and you think we're in a full-fledged bull market. I mean, look at this, okay? We're supposedly, the Fed was going to raise rates, keep them elevated, the housing bubble was going to pop, the commercial real estate bubble is going to pop, everything's blowing up, and you got home builders screaming to new highs here. Screaming. Now, yeah, right? Home builders where they were pricing in recession and the Fed raising rates, I mean, this is rate cuts all over it. This has got written. Home builders are pricing in rate cuts right now. That's my takeaway. I mean, look at these rips. Right? And I don't care what anybody says. Nobody saw that coming. So you look at, the point I'm getting at, you look at these names, right? You look at names like these home builders and you're like, wow, that's bullish. And then you start treating every sector you may have an interest in, thinking it's going to act as bullish. And that couldn't be further from the truth. For every little group like this that's doing this, you got groups that can't get out of their own way. So that's what's been tricky here. And the other thing too, a lot of the of more recent too, a lot of the strength and a lot of the outperformance has come from defensive names. They bought mega cap tech because it was defensive. The Mercs of the world, right? All these names that have been strong for a good period of time here are defensive. They're not risk on, they're not bull market type names. But again, it is what it is. We can complain all we want. It is what it is. It is what it is. There was one more thing I wanted to show you before we start shooting this shit here. Hold on. What was the So now you have a situation here where you've had mega cap tech rally, right? We're going into earnings season, right? And it's pretty obvious, right? You've had the crowding into a lot of these names, okay? Because of safety more than anything else, okay? Here's the problem. If you don't think we're in a bull market, right? You know what the most, here in quotations, the most crowded trade was in that BOVA survey this week? You know what was the most crowded trade? Mega cap tech. Okay? So, now you have a situation where you're going into earnings season in these names, and they're the most crowded trade out there right now. Again, right? Who would have believed that in December? They're the most crowded trade. So what I was saying, why if you don't think we're in a new bull market, in a new bull market, right? If the Fed's cutting rates or implementing QE, you can see tech linger as the most crowded trade for a few months. Like I've seen it in bull markets, QE bull markets, tech, mega cap tech and FANG being the most crowded trade, and it just would slow down or stop going higher. They wouldn't see any major correction or anything like that. But those were in QE bull markets, right? Where the market was rigged. If we're not going into full-fledged QE here or a new bull market, there's a lot of risk in these names. A lot of risk in these names off the runs that they had. And again, the crowding, right? It's the old thing, everybody in, and then, the last people in are any little weakness, they're all going to want to get out at the same time. And that's where things can get a little dicey. What stocks will fall if no rate cut? Oh, I think home builders, you probably see correct. Tech and growth, you probably see correct. They all have been pricing in rate cuts of recent. You'll definitely have repricing out there. You definitely have a repricing. Let's keep it sideways forever. Ani, at first people will see that and think you're nuts. It's not, it's not a crazy statement. It's not a crazy statement, right? I guess depending, the thing is like you get spoiled in bull markets. You think that there's going to be an abundance of great risk reward opportunities at all times, whenever you want. And, the market without QE just doesn't work that way. It just doesn't work that way. So, Ani's point is if you're more tactical and you like to trade actively, right? This type of market we've been in is not the end of the world. It's not the end of the world. It's not the end of the world. What was the name of the liquidity indicator? Just type in global liquidity, and you'll have a bunch come up and choose your poison. See? Global net liquidity. I think that's the one. But that's all central banks, all central banks. I tell you, Ani, to your point, okay, again, especially where you have what we're seeing now, okay, because you worry about the free fall to the downside and shit like that. Like 2022 was a disaster, okay? 2022, that's probably the worst type of market you're going to see for long players, long only players. You couldn't get long in 2022 until obviously the October lows. Okay? The market was rigged, right? It's not right now. You know what I mean? It's not. Again, you see what's going on with liquidity. The Fed and central banks as a whole just have taken a step back and letting the market forces do their thing right now. It's not a rigged game to the downside anymore. Okay? So the benefit to that is this dog, what are you doing? Throwing up on me? When you get these down drifts like this, right? When you get these things and you get sentiment on your side there, right? When the turn comes, they're going to be decent opportunities. Okay. The problem is when you get to these points, right? That's where more risk comes into the equation for any overnight stuff. It's, that's where the problem comes in. But when you get the downdrafts, right, or even these, okay, and again, depending if you're these little squeezes that last 3 days, all right, there's some decent moves in individual names there for, again, the more tactical player. But I think, Ani, the problem is, and especially like some of the newer traders, they see a move like Apple or Nvidia or home builders recently, and they get caught up in that move. You know what I mean? They get caught up trying to catch the next Nvidia or the next Apple, the next home builder, and you take on way too much risk in a sideways market, trying to catch those. That's the problem. But for people like you who like to trade, there's nothing wrong with this market. Honestly, I know like the type of names on you trade. I mean, last week, the week in this rally, put it this way, this rally here probably was as good to you as any other rally you've been in, right? With biotech names and so it all depends on the type of player, right? Yeah. It's going to be interesting, Bob, to see if the liquidity factor plays a part on those speculative names. But for me, and to Bob's point, like that's why it's just for the start of a new bull market. I'm just, again, the signs aren't there. The signs aren't there for it. The signs aren't there. The type of names, the type of action that has led. The one thing has been the semis. The semis has been probably the most bullish part of it, and it hasn't been all semis, but it's been a nice pocket of them. Right, the semis have been probably the most risk-on group that has done well. And look where they are here. Does this mean they have to go as an index, go to new highs and continue higher in a bull trend? Doesn't mean. But like all the other groups, right? You have gold miners have been outperforming. Prior to that, commodities. I don't know. Don't you think we should listen to Warren Buffett when he says there's more bank failures? Wait. What's he saying, Pete? I lost you here. He's saying there's going to be more bank failures? Oh, wait. He's saying buy the banks because of what's going on there? He said he would. Yeah. Well, and more bank failures. Again, if it doesn't lead to a credit event, it doesn't matter. But that will end up being bullish. That will end up being bullish, for the market. Because the likelihood is the Fed and the Treasury have to come in, bail them out. They got to pump liquidity into the system. So for the rest of the market. But for banks, I don't. He said there will be more. Oh, he's selling banks. Yeah. I'm not saying he's buying banks. That was the point I was making. For banks, I wouldn't buy banks. But I'm saying for the rest of the market, you may see what happened here off SIVB, this here, right? You may see this wasn't supposed to happen, okay? But because of the bank failures, this happened. So, again, it may not be bad for the rest of the market, is what I'm saying. More failures will spook the market. Yeah, but that could be an opportunity, is what I'm saying. I know what you're saying, but that may not be the death of the market. See this. This is like, listen. I see all the risk, guys. I see it. You know what I mean? I understand. I see all the risk. The problem is so does everybody and their effing mother. You know? That's why this looks like this. All right? Commercial. Oh, right, T. That's what I'm saying. Exactly. Exactly. So I think it could be a good thing. What I'm saying is for the Bears to get their golden trade, right? For everything to break down. And again, not even that. I'm talking about new lows, right? Just a new leg lower in a bear market. Okay, the Bears will take that. It's really difficult to get without some sort of major credit event when positioning is like this. It's just not likely to happen. Those cascade moves to the downside to new lows and then some, they come off of, you know what I mean? Off of high positioning levels, and everybody is selling everything, getting out. Like you need a credit event to really get things dicey to the downside. In my opinion, I think for you to get the new low scenario, I think you have to wear off some of this bearish positioning. Again, it's just an opinion, right? But that's my opinion. I think it's got to, like something like this, right? You're going to have to see this. They got to wear out. They got to reel them in a little bit. They got to get reeled in before you could have something like that. But I wouldn't rack my brain over that stuff. Okay, you could go nuts looking for this stuff. Like what I mean is the commercial banking sector blowing up, and you're going to hear about it constantly, right? But the more you hear about it, the less likely it is that it's going to happen. Okay, those 2008 nightmares. Everybody, including myself, we still see them in our sleep. But that was a rare bird. '08. That was a rare bird. What's more likely to happen, I think, is like that Drunken Miller scenario. And everybody thinks it's just straight sideways. Like you just go in a straight line sideways for the next 5 to 7 years. No. Like this market could go rally, S&P 500 rally to 4,500. Then you get banking failures like T's talking about. Okay? Then you get a correction down to 3,800 again. You understand? That's a 1,000-point correction. But it doesn't mean that you're at new lows and crashing. You could stay in a wide range. You could stay for quite a while. Right? And if I'm not mistaken, I think that's what Drunken Miller's calling for. Isn't he calling for that? And what do you think? Like, people hear that, like the Drunken Miller scenario, and think that every day, every week, every month is a travesty. No, you have bullish phases within that 10-year range, and you have bearish phases. You're not making new highs and cumulative gain years like we've seen, right? Up this year, up next year, up the following year. You're not looking like this, right? Straight up. It's kind of like, when did we have really a sideways market? We haven't had one since, this was one, right? No, what was this, 299? Yeah, kind of a little bit. But, we haven't had a true one like what Drunken Miller's talking about since like the 70s, the 80s. Mega cap tech, yeah, here, look. Just in case you think I'm making it up. Hold on. I don't know if you can make that out. Global Fund Manager Survey, most crowded trade, long, big tech. Okay? No, I'm joking, Tyler. I know you believe me. I'm just joking. But that's interesting, you know? And, you know, it's not long growth. It's not tech in general. It's what he's pointing out, it's long, those mega cap tech names, the ones that have been moving like that. We are waiting for the market to realize they cannot have a bull market on rate cuts this year. Yeah, I don't think anybody knows, Mayo. I mean, I know I don't know. Like, here's the point, Mayo, and we talked about this on this webinar a lot, okay? I agree with you. Like, there shouldn't be rate cuts this year. But what happens if something breaks? What happens if something happens? The Fed's going to have no choice. You understand? Like, they may not want to cut rates. They may not think they're going to cut rates. They may swear every day that they're not going to cut rates. But if something legit breaks, they may have to implement full-fledged QE. You know? So now, instead of rate cuts, what we may see is kind of what we just saw with the banking issue, right? That's what a lot of people are saying may happen too. Instead of the QE bazooka and rate cuts, they're going to take the fire hose and put out fires with liquidity, right? Oh, regional banks, boom, let's put that out, right? They're not implementing QE, but that's all fine and dandy until something big happens, you know? And the market forces them to cut rates. And that's like Hartnett's point, right? That's usually how this story ends, okay? The Fed can take the fire hose and put out fires, but then there's going to be another fire. Then there's going to be another fire, right? And then the only way all this ends is if the Fed fires the bazooka, right? That's the problem. Once you go down that path, once you go down that hole, you always got to go down that hole. That's the problem. You know, that's the problem. So, you know, again, I don't think anybody knows. I don't think anybody knows. But my point being for us, and I think it's a waste of time to try to forecast and predict it, because we can't. Again, nobody can't. I mean, nobody can. Nobody can't. Nobody can. You understand? So the best we can do in that regard is keep an eye on the signals which kind of are the smarter money hinting to us that there's a problem. Well, where'd it go? And when we start to see concern there, then we can worry about it. You know, once we see something like that happen where these things blow out, then we'll worry about it. Until then, you know, kind of like what Ani was saying, in this type of market, okay, and this goes for everybody on the long side, okay, not at all times, because you can get lucky at certain periods and, you know, step on a stock that, or an option that quadruples when you shouldn't be trading, right? Like, yesterday, you could accidentally, in the worst climate right now, earnings season, hit a biotech and your option tripled. Okay, so there's obviously that could happen. But for long-only players, the majority of the times, your best trades, plural, are going to come off dips. They're going to come off where the market has a down week or a down 2 weeks. Right? It's these things here, these little rips, where you're going to have some nice sized winners there. You know, you don't have to rely on just one stock. Because the problem is, right, and I'll give you an example. Here, and this is the major problem in this market, okay? Big tech was a great play. Like, you guys know, I'm no big mega cap tech fan, okay? But once you play in NVIDIA, or once you play in Apple, or whatever name, okay? And then you sell it for a profit, okay? Now what? You're going to buy it higher than where you just sold it a couple days ago to trade it again? Like, that's a slippery slope in a bear market or even a range bound market. That's a dangerous slope, right? In a QE bull market, you get away with it. But in this type of market, you don't get away with it. You may get lucky once or twice, but you don't get away with it. Right? If you buy a stock and you think it's going to go higher, you should have rolled or sold and kept some, right? To begin with. You don't sell it and then 2 days later buy it at a higher price again. So I think, that's the problem a lot of us are going to face in this, right? Coming off this recent rip, there was opportunity in tech in general. Since the bank SIVB went south, right? There was some decent opportunity in tech. Now, these names, the move is over, right? Now, again, according to the fund manager, the big tech traders crowded now. That's not where you want to eat. Or forget tech. Let's say you're anti-tech, right? The gold miners or gold, right? Same thing. Sweet move. There's been unbelievable winners. Or biotech. There's been crazy winners, right? I mean, this thing catches one goes up every day. But once you buy it and sell it, once you trade it, right, it's kind of okay. VK, the stock is done, right? You're out of it. Now you're looking for a new play. At this point we're at, looking for the next VKTX here is where you run into problems. Right, you want pullbacks, right? You want breathers, you want pullbacks. And not only that, when the market does pull back, when you get these pullbacks in the market, you're going to have a new batch of stocks and opportunity to trade, right? You don't even have to look at the same name a lot of times because there'll be others to trade. But it's waiting for that pullback, Like right now, what are you I don't care, even if tech goes higher, right? You're going to buy mega cap tech here now into earnings? I mean, come on, right? Like, even if it goes higher, it's got nothing to do with it. Right? It could go higher. Well, who's to say? It's not guaranteed that it can't go higher. But that's not how you want to play the game, right? You don't want to buy big tech now when it's the most crowded trade going into earnings. Right? That's the opposite of what you want to do. So, whoever said it, you want to see either consolidation or a pullback, or you find new names that are catching the action and the momentum after we take a rest and start moving again. So that's kind of where we're at now. You think inflation? I don't. No, I honestly, the inflation. I think the Fed. Put it this way: the Fed's got a hike left in them now. And if they do any more than that, I think this market will make them feel pain. I really do. I think, because I think the Fed I think they're done. But I think once the Fed is done, maybe that's when we get some legit selling for a change in this market. I think that's kind of what's holding the bulls in right now is the Fed is done. And that's what the bulls are playing off of. So what I'm getting at is I think the economy matters more. Okay? If the economy really starts to deteriorate, I think that would be more of a concern to the market. I mean, inflation, it's almost like the Fed or central banks right now, again, have taken a step back and have said, okay, let the market do its thing. So put it this way, Eric, and I know it almost comes across as unprofessional, but I don't know any other way to word it. The worst case scenario is if the Fed has to rig the game to the downside like they did in 2022. You know, that's the worst scenario for the market. Okay, without without that event, without that occurring, the only other risk to the market is if something breaks and the Fed needs to step in, right? Kind of like we've seen with SIVB. But the Fed's going to step in, right? So it's going to, like T is saying, that's going to end up being an opportunity. Like, we're all focused on 2022. You got to understand, that was the Fed rigging the game. You understand what I'm saying? That was the Fed rigging the game. Now, do you think the Fed is going to rig the game again? Like, you know what I mean? Doesn't look likely, but I guess it's possible. But how do you predict that? You can't predict that. Like, you can't even pretend to predict that. Yeah. Ark, Kathy's got, what you would call it, Tesla and Bitcoin going to 300,000 by the end of 24. And listen, what happens? The Fed rolls out a whole full-fledged QE. Maybe we start building the biggest bubble ever. Guys, I'm not going to sit here and pretend like I have any idea how any of this is going to turn. Nobody has a clue. Okay? Let's be dead straight. Nobody has a clue. We could talk about this for amusement purposes only. I'm sorry to tell you, nobody knows. The Fed doesn't even know. Nobody knows how this turns out. You know what I mean? Nobody knows. So, you remember the point we were trying to make over the last few weeks, okay? Like, you get paid the big bucks in this game to anticipate moves, right? That's why in bull markets, you kind of want to anticipate moves. That's how you get paid, okay? But when you're in this type of market where it's stuff you've never seen before, nobody knows how any of this is going to shake out, all right? You want to be more reactive. You understand? You don't want to get stuck in a thesis or a prediction, because that's how you get mangled in a market like this. Okay? You may not think the Fed will ever cut rates. You could be proven wrong next week if something happens, whether you like it or not. Nobody has any idea. Right? Nobody saw 08 coming when it came. So, if we start to see things light up that are showing us there's concern about shit unraveling, okay? We don't want to say, oh no, this is a new bull market, and just keep doing what we're doing now or since the October lows. You want to step aside and let things shake out. But if we're not seeing any of those signals, you want to try to make some money. It's worth trying to make some money. But again, it's not easy. I'm not gonna lie to you. It's not easy. It's not that easy like some claim. Even if we hold lows, even if we continue to do what we do, I can promise you, you're going to be frustrated aplenty in a market like this. You're going to be frustrated. In a new bull market, there are new leaders, new stories. You fall in love with new names, new sectors, new technology. That's a new risk-on bull market. But in this type of market we're in right now, it's a menagerie. You know what I mean? There's no other way to put it. It's a mess, and you gotta dig through the mess to try to find some opportunity to make some money in, and it's not smooth sailing. It's not smooth sailing. And remember the analogy, for those of you, some people don't want to hear it this way. Oh no, the market is not gambling. They don't, again, these are new Pepsi-Cola Rocketeers who have been in the game a couple of years. They have no clue. Okay? This game right now, you got to treat it like your DraftKings account. I'm serious. Okay? You're looking to hit more bets than you lose, but the more important thing is you got to manage your bankroll properly, okay? And just try to be patient and wait for the higher risk reward opportunities, the better setups. That's the most you can do right now. But there's no other way. It's not going to turn out any different because you wanted to. You got to treat it right. You're playing, I don't know, 8 stocks throughout the month, right? You want to finish 5-3 and pocket net money, and you did your job, right? You guys know what I'm talking about. But for those who came into this game post-COVID or even post-2008, that, oh, no, I'm not gambling. I don't consider this gambling. Yeah, you've never been in a sideways market, let alone a bear market. You were in a QE bull market. Yeah, but Eric, that's the toughest part for a lot of people, and that's just the degenerate blood we have in our veins. Is waiting for. See, because the problem is even the better setups are going to go down. You're going to lose money in this type of market, right? Even the good setups aren't going to turn out your way as much as you would like in this type of market. So it weighs on your patience for waiting for those good setups. That's the problem. But to Eric's point, you have to try whatever it is you're using, right? Whatever edge you may have that you use to pick stocks or pick setups and spots, you want to try to wait for the better ones in this type of climate. It usually pays off. It usually pays off to do so. It may not pay off on that one stock, but net big picture usually pays off. Exactly. That Ani, I dead straight with you, I consider myself that more than a trader. I really, like the definition of a trader, I don't put myself in the pure definition of a trader, I'm more of a professional gambler, without a doubt. It's all about managing the bankroll, right? And placing the bets you think you have your, better edge in, right? Higher probability in. But, like professional gamblers, you sit around a lot of times waiting, doing nothing, waiting for that edge to set up. It takes time. And, honestly, I think right now, again, depending on the type of trader you are, but right now, I think we're kind of right there. That's where we are. We need, at the least, we need a little dippity doodah here, to open things up a little. Yeah. Well, but see, traders, like, when people hear traders, they automatically assume they can come in and trade anything at any time. And the God's honest truth, I can't do that. Like today, there was no way, just literally in the first hour of trading, I knew I had zero confidence in anything today. Zero confidence. I would have zero confidence in anything. I just felt it in my bones today based, off the flow we were seeing. And, look, like you saw the market, the type of, that was a nice squeeze this morning. I didn't participate not one bit in this. Nothing. Okay? Just because there was just based off the flow, there was just nothing, I felt like I had no edge in anything. There was no edge for me. So that's what I mean. Like, some traders are going to get in the middle of this and trade and make some money. Me, based off what I utilized, I just couldn't do it. I felt like I was handcuffed today. Yeah. Yeah, that's a good point. Well, you know what it is? Gamblers, there's degenerate gamblers, and like I'm saying, there's professional gamblers. Like you guys heard the story um, that I tell you guys about, like my friends of my father, right? My father went to the racetrack, and if there were 10 races that day, he'd bet 12. He'd find track in Japan to bet simulcast. That's how big of a degenerate he was, you know? But his friend, who never worked a real job in his life and was a professional gambler, gambled for a good living, he would go to the track and literally, I was amazed how he could just sit there. He would sit at like the table, eat, drink, read the paper, and he wouldn't bet on one race. Because he didn't have, he didn't have an edge in any race. He wouldn't take $2 out of his pocket and just for fun even bet any race because he didn't have an edge in it. Right? That's the difference. Like my father was betting the whole card. Like he was trying to make money, my father, betting all 10 races throughout the day. Where the professional guys, they go there for one race. One race that they have an edge or tipping, right? They have an edge in. And that's the difference. So, and think about this game, right? This game is so similar. You have, a lot of us too would want it. You have the action, right? You want to trade. There's stocks. You got, in front of your screen, there's stocks going up and down all day long. Right? You want to try to make money in something. It's tough to sit there and not do anything while watching all this or watching people around you actively trade 10 stocks throughout the day, right? It's hard to sit there and do nothing. So that's the difference, Yeah, definitely. But this market, again, if this market continues the way it has been, it's going to weed out a lot of the degenerates. That's what usually bear markets are known to do. They weed out the degenerates. The degenerates get bored. They're there for the action. But once there's not enough action, right? They can't make money. There's not enough action for them. They leave. And they're not around for the start of a new bull market. That's usually how things shake out when you get into these type of cleansings. Many gamblers play the game to lose. What do you mean play the game to lose? Oh, they lose. Well, of course they lose, if that's what you mean. Everybody loses in everything. There's no such thing. And, like that's what I mean. Bull market, sometimes you go on these hot runs. You don't know what you got until you officially lose. You have to lose to learn what the hell you have, What do the losses look like? Forget the gains. The gains they always look good. When you lose, what does it look like? That's more telling than anything else. That gives you more information than anything else. So the disciplined player here right now, right? You want to be disciplined, okay? And again, there's scales of discipline, right? But if you want to be disciplined here you got to sit tight. You got to sit tight at the least. Even, if you're the more tactical player, you got to sit tight and you're hoping for some sort of rinse, right? Some sort of even if it's a 1-2 day little rinse. And very possible you find buyers come in and you got a better trade set up there for a couple days, right? Like that's what you need here. Here, it's kind of you could see it's running on fumes here. If you ain't losing, you ain't right. That's 100% right. And no, listen, nobody likes to lose. Let's be honest. I don't care how much you're learning. Losing sucks. I'm a sore loser. I hate losing. But there's no such thing, there's no such thing as not losing, right? Like even like me, I'm a little baby. I'm 90 years old playing fantasy baseball still. When I lose, I want to punch my hand through a wall. But You gotta lose. You're not gonna, there's no such thing, not losing. There's no such thing not losing. You have to lose, and you gotta stick with it. You gotta lose, and you gotta stick with it. I'm not talking about stick with the game. I'm talking about stick with whatever edge you have, right? You believe you have an edge. You have a loser. You have two losers. You gotta just stick with it. All right, those are two losers. Okay, if I really do have an edge, likelihood is they're gonna be made up on the back end here. All right, that's how you gotta look at it. But it's frustrating. T, have a good night, T. So that's where we're at here in the market anyway, right? Again, we'll see. We got earnings now because now you got an added catalyst. But the other thing, we didn't even talk about it, right? This VIX, up until today, created a problem here, right? The VIX ruins these rallies when it does what it does. It adds more risk into the equation. Right? You had VVIX strong the past couple days, and you had the VIX melting down. That usually doesn't last. Usually it leads to some sort of rinse. And maybe today was the start of it. Anybody come out with earnings today? Well, there's no big earnings today, is there? Any market moving earnings? No, right? And we'll see what big tech looks like. It just may be a nothing burger. Maybe they just, they sell off big tech because they had a big run up, and they just linger. But some of these things, look at these moves here. But right now, God's honest truth, I feel like, and this is even last week too, I don't feel like I have much of an edge. Like today I played, even intraday, today I played zero, nothing. Literally, I didn't play anything. Yesterday I played a couple things, but I played a regional bank yesterday. They caught some decent steam. But in this, I got nothing in this. I got nothing. And I know you guys have been killing it in biotech. I get gun shy day trading biotech because, I'm playing the equity. I don't want to get caught in some FDA halt or some shit. So I really, if I play biotech, I scalp it at best. FCX tomorrow. Yeah, that's what I'm saying. Maybe even earnings we get, Praveen, we get a couple sells. They sell them off on earnings, and maybe we get some bounce plays that way too. You know what I mean? Just to play a little bit. But today was a mess. What else is there? Some of the I would keep an eye on the high growth with liquidity now. Because some of those names were looking good. Some of those names were wasn't this thing was moving right? VKNG. Yeah, look, it had a little move out of this thing. But this can come right back down, But for trades, they haven't been too bad. Oh, Praveen, you know what else has been a beast? These casinos. But you had them bump up off earnings. Look at these things. They've looked good, these casinos. There's been some bull market pockets. What else is there? Is anything else we usually talk about that September XOK? No, there was I think if you're talking about the call buyer, it looked clean, but Praveen, you got big tech earnings. You know what I mean? I wouldn't trust it, if that's what you're asking. Praveen, honestly, I'm not just, brushing it off to not answer any of your questions regarding flow, but you can't, there's nothing, okay? You can't trust anything. I'm being dead straight with you. I'll give you another example. STZ, okay? This is post-earnings buying. Nice buying. They're accumulating June calls, okay? But a buddy mentioned this to me today. I didn't even realize it. He thinks it's a play on a couple of the, I think it's the beer names or some shit reporting. You know, you can't trust anything is clean, especially like tech ETF with big tech earnings next week. You know, you can't trust it. And that goes for puts too, guys. Anything. I think if you're looking for any edge off the sweeper activity right now, the only thing you could possibly look for is you want to see short dated, even weeklies, okay? But you want to see swarm, you want to see multiple sweeps, and the only edge you have is that it creates some momentum intraday, and you're trading off that momentum. Okay, I'll give you an example. I mentioned regional banks yesterday that I played a couple, right? Okay, look at this piece of garbage. Okay, this thing can't even bounce. Look at the beating it caught. All right, but yesterday there was a little window where multiple sweeps started coming in, and not just this name. They hit up a couple other names. Some of them had earnings, some of them didn't. But you could see there was a band of sweeper buying that came into these beaten down regional banks. Okay? It could be even shorts hedging into earnings. But what I wanted to do, because that buying came in so aggressively, I just want to get in the middle of this. You understand? Because when they buy like that on an intraday basis, you're going to see this type of momentum. You're going to see some momentum. So I just want to get in, get out in the middle of this somewhere. Like that's the only thing that I'm looking for right now in this type of tape with earnings on the forefront. Now, I wouldn't dare hold it overnight. I mean, a lot of these things have earnings any minute now anyway, you know? But that's it. You know, in a regular environment, if they didn't have earnings and this thing finds aggressive buying, maybe you want to hold it and catch a squeeze here. I mean, this thing, look at this. It's dead on the concrete floor here, this stock. Right? So maybe you get a little bump up here and you get a nice squeeze. Could go from 10 to 18 in 3 days. But with earnings, you got too much risk. You know what I mean? You got too much risk. So that's what I'm looking for. Now, today, there was literally, not that I remember, there was no action like that. There was no steam where they came after anything. I mean, maybe, did they come after anything today? Praveen might know better than me. I don't remember anything they came, did they come after anything multiple sweep-wise? Where they, Google in the morning, right? But I can't play these names anymore. They came after Google early morning off the open. Oh, I didn't even realize that actually had a decent run too. Look at this. So you know that's honestly, or if you're just trading off sweeper activity, in my opinion, that's the only edge you have. Okay, and it's speculative action. Usually. That's not the action we want to play off of anyhow, right? That's degenerate spec action. But it's got a better chance of creating intraday momentum, okay? Right now, you could see, and we see it, you could see a $10 million sweep come in, and it's not going to make the dent it would because it's probably earnings related. All right? That's... Nvidia caught, didn't Nvidia catch like a $40 million bet or something? You know, but they're piling into these things right now. It's a little crazy. Oh, Tesla it was? Tesla. You know, these names, they catch action in their sleep. But you get an underbelly name that they swarm into. That's ideal right now. You know, not one of these mega cap names, but a mid-tier name that catches a wave of sweeper activity, and you could get some momentum. CTIC, what is that? A biotech, I think, right? Or no? CTIC. Yeah, there's been a lot of biotechs. You know, this name that I showed you guys before, I know a couple of you caught it. I don't know if anybody's still holding it. I mean, this is insane. I never catch these things anyhow. Even when I hold them, I never catch them. They literally buy this thing every day. Like, it's out of control. It's out of control, this VKTX. Was there? Yes, INMD. There was more flow in it. I think they report in May, so you got a little time. Look better of late, right? You think you could get a little more move before earnings, or are you holding? This is a profitable name too. It just gets lumped up into the growth sector, and they sell every rip. Like, this is a good little stock, this INMD. It's not tech, it's health related, isn't it, Steven? Yeah, right? This is the one I'm thinking of? Yeah. This is it. It's just a growth stock. That's the problem. Yeah, they bought some May calls again that cover earnings, May earnings. They're looking to earn 46 cents. So, you know, I don't know. You know, do you get more of a push, especially if these growth names sell off, if liquidity starts to drain a bit? I really don't know. These things have been so, you know, another name that the flow's been decent in. Again, can you trust it? I don't know. Snow. You know, well, it's been put selling mostly. A couple nice put sellers in it. Later, Ronnie. Have a good night, brother. You know, a name like this, I would probably wait, hope you get a dip off earnings and see if they show up again. If they're real, they'll show up again. If it's earnings positioning, you won't see them again till next earnings. You know, I like this setup, you know, because it's a hockey stick and it's just dead here. You know, I like that it's dead here. Maybe you get a squeeze like this, and that's pretty nice. What is that? 130s to, I mean, that's almost a $30 rip there. It looks like nothing. Yeah, July put selling. So you got time till earnings there. Oh, wait a, oh yeah, late May. I thought it said April there. Late May. You know, but again, it's tough to trust ahead of earnings. The better play would come post earnings. But you know how you play this? You buy it and you put a stop. You know what I mean? And you try to catch it that way. That's your only shot. And hope it don't cap down on your ass. It's got risk. Everything's got risk. Well, there was it seemed like, remember this? I remember, I don't know who, a couple of you guys were interested. Like, look at this. This is the problem with these. Look at this. Okay, there are trades here, but you got to get the hell out of it, right? Like, let's say you bought here, this nice spot, okay? You had a couple-day rip. I think it saw flow, actually, right here, too. It definitely saw flow, okay? And you know, you're thinking maybe you want this, and boop, now you're dead. Right? Now you're dead. Now you're dead. It's tough. I don't know. I don't know, you know? Right now, again, post earnings, talk to me. We'll see what kind of action we have. Right now, I have no idea. With this flow, I'm lost. What else quickly? Any other names you guys are looking at or have been trading? I mean, biotechs have been great. We know that. You know, even this name, right? Like this is one of the safer names. Has been grinding higher, but you know, here now, what do you do with here now? You can't do much with it here. What else? What other names? Home builders. What's another spot? There's nothing too much recent, right? Commodities, dead, right? Commodity, energy names, they're dead. There's no life in them. Gold miners are cooked. Oh, they're starting to. Here, you're getting a little breather now in gold miners. Hallelujah. Hallelujah. What are you going to do? You're going to buy into Pink Panther here? Good luck. But now you're getting another start of a breather. So that could be good. I don't know. What else? What do you guys got? Anything? Or you're in the same boat I'm in? AI. Yeah, I can't touch these AI stocks here now. No way, Jose. No way, Jose. This is beyond my time here. Now you even got the biggest crap of the crap that's been running there. I would stay far away from that stuff at this point. Far away. Yeah, these, again, if we were in QE environment, different story. But now, you know, you got to be early, in and out. Otherwise, the air could come out real fast. Oh, yeah, STNG. You got earnings there. Maybe, I mean, you got a little dip right now. Oh, a little dip. I mean, it looks good, Mal. You know, it's just, it's had its thing already. Look at this. I don't know, Mal, if who you are exactly by that name, but I don't know if you know where we were talking about this thing. You know, it was in the teens, catching action. You know, now it's up at 60, and they're still buying every dip. But it caught some action recently. Again, good looking action. You got earnings coming up. Look at these numbers: $3.26 for the quarter. They're printing money. What happened to AI today? What do you mean, reversed? I didn't see it at all. Let me see it. Oy, 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 oy. I wonder if they're front-running liquidity drain in these things. That's what it looks like, right? In Bitcoin and some of these things. Well, we'll see. Sooner than later, we'll see here. Because it's not supposed, I mean, as far as liquidity, supposedly it's not going to come out all at once. It's going to be a gradual thing initially. So maybe you get some bounces and fits and starts and stuff. But, you know, you got a lot of air underneath this. A lot of air. You know, the thing is, right, like the banks, the only setup that looks decent to me at this point now are the banks, and they're on fire. Some of the big guys have bounced nicely, though. The only thing is you got regional banks left. Some of them a little bit of a bounce. Like Schwab, right? That bounced a little bit. You know, the small caps. I traded TNA, yesterday, and it went nowhere. I was so annoyed. The market, I was playing a market bounce, and I was going to play, I played it through TNA because the regional banks were catching a little bit of flow. It went nowhere. And the market bounced, and it went nowhere. Where is it? Oh, no, I played it over here. Stop like a clock. Prevenient CTAs are done. Dunzo. Here. Ready? I'm going to show you a chart that tells you everything you need to know. You ready for this? You're going to like this. There you go, Praveen. Look at this move, Praveen. Look at this. Okay, CTAs are done. So here's what it looks like. Well, it was coming into today. They flipped from notably short. Now they're 25 billion long. Flat tape, 4.5 billion to sell. So now they're selling in a flat tape. Crazy how fast, right? Cooked. But you see why I like again, not the Goldman retail research, the institutional research. They were giving us a heads up that this was coming, you know? But this move is sick. These moves, it happens often, as you can see in this type of market. Look at this. Crazy. So yeah, again, I think this and positioning from safe haven back to risk, right, the other way, that's why we've seen this ridiculous buy the dip, every little dip. So I think we're going to start to see that subside a bit. Hedge funds, yeah, hedge funds, this was interesting. We talked about this earlier. You weren't here. Matt King, the liquidity guy from Citi, thinks hedge funds are getting short, front-running the tightening of liquidity that's coming. The last 5 minutes in SPY? What do you mean? What happened? A bounce? Oh, that's normal trading. I don't think anything. Yeah, you got probably short covering. You know, probably short covering. But again, listen, I'm not saying you got earnings here. I think the reaction to earnings is going to dictate the short term. You know what I mean? So just because the buy the dip from CTAs and all that's gone, doesn't mean you can't grind higher. You know, you got some big earnings that might move markets here over the next week. So, but what I'm saying is, I think now we have a better shot of getting a little whoosh. You know what I mean? Kind of something like this. And then it could set up something like this for us. You understand? So we get a little whoosh, and then you get maybe some short-term sentiment and stuff like that to line up, and then maybe you get like a couple-day bounce. Exactly like this. Yeah, almost similar to what happened in February here. So, again, it was hard to even see that with CTAs buying every dip and the huge influx into cash, you know? The unwind of that, I should say. But now that you started to see both, right? CTAs have a full tank and money market outflows. I mean, so there you have it. So I think, again, we got a better shot now to see a little shake and bake here. But how could you even handicap that now with earnings? You know what I mean? How do it can look good, right? It can look like it's materializing, and then you got huge earnings at the bell, and, you know, they beat the street, knock the bull out of the park, and you get a gap up the next day. We're in a tough cookie here with earnings. It's a pain in the ass. It's a real pain in the ass. So I think, you know, we still got to kind of stick to intraday and, you know, reevaluate. We'll see maybe if we do get a little rinse. Again, kind of like this, you know. Oh, this setup here. You got a couple day rinse, all right? and then squeeze them. We'll see. We'll keep tabs on it. All right, guys, I'm out of saliva. I'm going to wrap it up. All right, we'll see what Hartnett has to say tonight. I think Hartnett's a seller here, seller of the last rate hike. He just thinks you can't get too bearish yet here because of the positioning. These companies can't say anything. Yeah, because a lot of, again, I think, Ash, I know it's really, it almost sounds too simple, but I think this, okay, is the reason why no bad news can get much of a reaction. You know? Again, it's got to be something legit's got to break for you to get some selling. And, you know, then if the Fed and the Treasury react, right, you're going to get a nice bounce out of it. And maybe it ends up being a more bullish situation. But when you got this type of stuff here, like, look at this. This is craziness. You know? This is a lot of bearishness positioned in already, you know? That's what this is. Everything bad that we're hearing this is what they mean by priced in. Everybody is positioned for it. The problem, see, if we have this setup and you're getting signs of a doable market, you know, you're getting new leadership, you're getting the right sweeper activity, the right price action from the right side, you know, you got that climb a wall of worry set up. I think now you have the worry, but you're not getting the climb right now. You know what I mean? I don't know if that makes sense, but that's kind of like what I'm seeing here. The worry's there. You got a lot of bearishness priced in here. But again, you know, because of the macro or whatever it is, or maybe because passive investors haven't thrown in the towel yet. But then, little by little, we'll see what the equity inflows look like today. We're probably going to see some inflows because they pulled out of money markets. But it's been a gradual outflow process so far. So it's taking time. Patience, my friends, patience. All right, good luck, everybody. The Friday, tomorrow, OPEX Friday. So it might get messy, especially early on. And again, we got some earnings, so take it easy, relax. Treat it like betting the bowl games for another week or so, and we'll see if something loosens up by that point. All right, thanks for stopping by, everybody. Enjoy the rest of your night. Little by little.